You're literally a subordinate creditor on your bank accounts, literally.
We're not allowed to actually own anything anymore.
You don't have property rights to securities. All the arrangements between transfer agencies, custodians, exchanges get centralized to DTCC.
The stocks in your account, your Apple, Tesla, Google, etc., you don't actually own those. With Bitcoin, it's a bearer instrument. If I have the Bitcoin, I have the Bitcoin. No one can take the Bitcoin from me.
Bitcoin's the embodiment of the Bill of Rights in technological form. Even gold has way more risk than Bitcoin. There's so much money waiting to buy Bitcoin, it is insane.
Larry Fink from BlackRock is talking about this. Hey, well, let's just tokenize all these real-world assets.
It's still not fully decentralized.
It can't be decentralized because it's a real-world asset.
I don't think we've ever seen anything good come out of BlackRock.
How do you see that playing out in light of these types of laws and regulations that are in place?
The maybe cynical, skeptical, nefarious viewpoint of that would be
Bitcoin's on the move, making new all-time highs, but where's it going? This is a conversation I'm going to have with Chris Sullivan today. We're going to talk about the bigger picture. What's going on with politics and DC? What's going on with macroeconomics? Where's global liquidity? What are the price levels, things we should be paying attention to? And what can we do to protect ourselves if there's a big move down? Let's go right now into the conversations with Chris. All right, Chris, thanks for taking the time to join me today. Excited to see you again.
Thanks, bud. Happy to be here.
So for the audience just catching up, we were both just together out in Washington, D.C. at the nation's capital for a new event that just started called Bitcoin in D.C. and it was all about policy. Pretty interesting. There was a lot of lawmakers that were there at the event. I believe you were there even before the event was going on. So what's going on in D.C. and what is the thing that most people, maybe most Bitcoiners don't really understand about how politics are looking at this?
That's a great question. I think it's easy to just say self-sovereignty, Mark, but it's another to analyze existing legal structures and upend them with a sovereign-based policy and restructure that. Like you know as well as most, beginning in 1964, culminating in 2010, U.S. citizens, well, in Japan and Europe, lost property rights to securities, right? And so if we're going to be, okay, I have my cold storage in my hand, great, but there's a more macro prudential element of that where I think we have a duty as Bitcoiners to address legal concerns on that sovereignty level for all assets, whether it's real estate, gold, which has been confiscated from U.S. citizens before, and certainly with respect to Bitcoin. And so
what do you mean we lost property rights to equities?
You don't own property rights to securities. So beginning in 1964, the process was called dematerialization. And little by little, getting to the safe harbor provisions of 2010, which just put the nail in the coffin, it went from you have total ownership of your positions and assets to they're held in street name for you at a qualified custodian, approved custodian. And all the arrangements between transfer agencies, custodians, exchanges get centralized to DTCC.
Yeah. So before that, we had bearer instruments. Those were stock certificates, and those were bearer bonds. And if any of you are old enough to remember something like the early James Bond movies or whatever, they'd be trading bearer bonds.
Mm-hmm.
And so whoever held the bond certificate or the stock certificate owned it.
Correct.
And what you're saying is that through that process, that was taken away, and we're not allowed to actually own anything anymore. We're in a debt-based system, and so everything is owed to us. So under the new system, this doesn't mean a lot to a lot of people, and maybe they don't understand the nuance of this, but like the stocks in your account, your Apple, Tesla, Google, etc., you don't actually own those.
Mm-hmm.
They're owed to you. Why is that important for people to understand the nuance of that?
Well, because it allows for a couple things that have been hotter topics since COVID, right? There's a lot of awakening occurring and people are paying more attention than they did before. But it's essentially twofold. One is understanding the daisy chain of collateralization that occurs. And two, understanding what your actual risks are. Not because I don't view price as risk, price as opportunity. So what is the benefit or lack thereof of having those relationships? And then you go to your representative and relitigate, renegotiate the terms of those, right? So if we hold, let's say, $1 million worth of Tesla, it can be rehypothecated an uncountable number of times. And in the event of a custodial bankruptcy, you're screwed.
Right.
Like sorry. And you can go through, David Rogers Webb is the author of The Great Taking. He actually has the letters of the regulators outlining the actual language. And then you got to go read UCC 8.9. It's right there in front of you.
Yeah. And most people don't really understand the implications of that because we haven't actually seen that. But in the Bitcoin and crypto space, we certainly have. And so people found out, unfortunately, the hard way when BlockFi and Celsius and FTX collapsed, that the assets you thought you owned on those platforms didn't actually belong to you. So in the bankruptcy event that those all went through, the assets went with the bankruptcy and you got any little breadcrumbs that were left over, versus if they still belonged to you, you would have got them back outside of the bankruptcy. And so the same is with the money in your bank. The money in the bank is not yours. You own it. Or I'm sorry, they own it. It's owed to you.
You're literally a subordinate creditor on your bank accounts. Yeah, literally.
Yeah. So, that's one interesting thing. There's a lot of talk of tokenization of RWAs, real world assets, onto the blockchain, where Larry Fink from BlackRock is talking about this. Hey, well, let's just tokenize all these real world assets. How do you see that playing out in light of these types of laws and regulations that are in place?
Great question. It's so the maybe cynical, skeptical, nefarious viewpoint of that would be it's a trap door to reliquify assets they've already monetized and have possession of, and keep a closed system around those so-called real-world assets so that they don't permeate into the DeFi arena, where outside their control, outside of the collateral. That's why in the Genius Bill, they're forcing these stable coins to have treasury collateral at the banks. Then the banks can lever them 50-1.
Yeah, but how would, so if BlackRock or Robinhood or whatever put these stocks, the real world assets, and maybe even real estate assets or business assets onto tokens, I mean, they already have control of those. So I'm not sure what you mean by it would kind of keep control over that, because they already do.
Right, in the current legislation form, right? So all they're doing is liquefying again, right, and giving us, albeit there's great settlement structures, capital efficiencies of tokenization, for sure. I'm not saying that's not a bad idea, but it's basically like a resell, right?
Right.
And then it makes it interoperability between their closed system to generate more commissions and fees on top of the same asset.
Yeah. Because the way I see it is that it's like, to the point that you brought up and we're discussing, is that because we're not allowed to own anything. So with cryptocurrency, with Bitcoin, it's a bearer instrument. If I have the Bitcoin, I have the Bitcoin. No one can take the Bitcoin from me. Crypto people would sort of also say the same thing. Maybe it's not as decentralized and secure, but let's just say that crypto overall, what people are sort of used to, is also, I have the token, I have the token. And so they would think that then tokenizing a stock or a real world asset like a house or a business would then allow me to have that token. And then you and I could exchange Tesla or Apple, Google over dinner, just like we would exchange Bitcoin. But I've often said, I don't see how that's possible, because we certainly have the technology for that today, but it's the laws and the regulations that are going to prevent it. So now we have to think about, okay, how do we overturn all these laws and regulations? Now, maybe BlackRock has enough power to do that, but I don't understand what they see as this vision Larry Fink's trying to sell to the world of tokenizing everything, if it doesn't work or the laws and regulations would prevent that.
Yeah, I think my objective view is it's a trapdoor.
Yeah.
And I don't think we've ever seen anything good come out of BlackRock. There's certainly nothing that has come out of the World Economic Forum other than various repackaging of slavery. And we have to be conscious of what we're facing at the legal level before we can get to the technological level, right? Because so I was part of a project tokenizing the first commercial. It was, in terms of tokenization, it was the third. Red Swan was the first commercial real estate project that was mixed use in Miami, 350 mil build, had multifamily, retail, restaurant, hotel, went on AVAX. and learning all of the minutia of what's required at the ATS level, 4-step process at the custodial level, we ended up taking as a sponsor a 7-figure loss, Mark, because wait a minute, I can't pull this and swap it on Uni, or I can't hold this on a ledger or a Trezor. And it was that realization of, dumb and not knowing the full minutia of the details, just assuming, a token can live in the DeFi space, that we learned the hard way. And then sure enough, about a year ago, the Great Taking book came out, which has kind of caught fire amongst Bitcoiners. And Mr. Webb summarized it way better than I can do.
Yeah. What I've seen from some of these platforms like Robinhood that's working on it, BlackRock's working on it, even Kraken now is rolling out a platform, but they're all sort of approaching it a different way. So like one, it's like if I have an account with Robinhood, you have an account with Robinhood, we've both been KYC'd from them, and you and I could trade Apple or Tesla, Google between us in that closed system, but I couldn't trade with somebody with BlackRock, for example, right?
Exactly.
What Kraken is doing, I believe, is taking that asset and then wrapping it into an asset that represents that share. So then they'll take that stock, not certificate, that stock asset into their custody. They'll wrap it with a synthetic token that then you can trade the synthetic token. It's not really a bearer instrument, but it represents that. And then the way it works is then I can have that synthetic token, that wrapped token, as a bearer instrument. But if you want, I trade it to you for dinner, and then you want to redeem it, you got to go through the KYC process.
Which is, in my view, one step better than the closed system, but is still not fully decentralized and giving you the sovereign.
It can't be decentralized because it's a real world asset. It's a business. It's a company. It's an equity, right? So it can't be decentralized. It's impossible to, which then makes me think, then what are we even doing here? It just seems so futile. Like, what's the point? Because they're all a stock is already a tokenized share of the company. And we're trading it digital, so what's the difference?
It's essentially legal rights to the earnings at your pro rata share of the distribution of that. Like, yeah, you're right. It's already a token, so to speak, 100%. In my view, it's another monetization scheme, as I mentioned. And sure, because we're market makers as well, it's way better to do that where it can settle constantly than have to go get ready for 3:30, then a forward, and then, futures close. Like, that's a pain in the ass. It's not capital efficient. It's not cost effective. So would a tokenized version of those same things be better? Yeah. But then you're going to have huge opacity, probably lots of lawsuits. So is there going to be a world where there's a non-token ticker and a token ticker? How are you going to distinguish? Is one worth more than the other? Because there will be probably arbitrage, right? Because there's demand or supply that imbalances. So I don't think people are really underwriting all of the minutia here properly.
Every day we see headlines about inflation and debt and diminishing control over our own money. That's why I always come back to Bitcoin, because it's built for generations. It's built for legacy. But protecting your Bitcoin legacy the right way, it's not always simple. It demands discipline, focus, and the right partner. Now, that's why I personally use Unchained Signature. It's a premium private client service for serious Bitcoin holders who want expert guidance, resilient custody, and an enduring partnership. Now, with Signature, you're paired with your own dedicated account manager, someone who understands your goals, helps you every step of the way. You're going to get white glove onboarding, same-day emergency support, personalized education, reduced trading fees, and priority access to exclusive events and features. Unchained's collaborative custody model is designed to provide the same security as the world's biggest Bitcoin custodians, but for those who prefer to hold their own keys. Now, I've been using and recommending Unchained for years. I even got my parents to set up with them. So if you want to get set up, check out Unchained Signature at unchained.com/MarkMoss. And as a loyal listener, I got a discount for you. Just use code MOSS10 at checkout to get 10% off your first year, because your Bitcoin isn't just for life, it's for generations. And then when you think about, when I think about it from a first principles level, a token just represents a fractional ownership.
Mm-hmm.
So then you hear about, well, what if we tokenized real estate, for example, or businesses, for example, and imagine all the liquidity that we could unlock with that, right, for example. But it's like, If it's fractionalized ownership, I can already put it into some sort of a entity, a corporation, LLC, et cetera, and create as many shares or fractional ownership units or whatever as I want, number one. But you also just mentioned something right now, efficient markets. And so in order to have liquidity, we have to have efficient markets.
Correct.
But how does somebody price a Grant Cardone 500 unit multifamily property in South Florida against a office building in Silicon Valley? Like, I mean, what is one token versus the other? Like, how is that compared to a 3-bedroom, 2-bath in Indianapolis, right? So then there's no way one, those aren't fungible. Two, I can't compare those against each other. So then it's not an efficient market, and it doesn't increase the liquidity.
No, and because of all the points you just said, that's not going to attract market makers, which are required in order to have a thick order book for a narrow bid-ask spread, right? Yeah. And because there's such a variance there, even as that coming from a sponsor seat, like I'm the real estate GP, putting capital build, I'm sponsoring the sale of shares and or tokens. It's cool to liquefy what we were trying to do is liquefy 30% of it, right? And have a secondary market that trades so that investors weren't sitting in a 500 mil type of investment forever, just getting some dividends and then waiting on a sale to insure or a pension. So that concept is fine. But then when you go to practice, how does that have an efficiently traded market? It becomes really difficult. Yeah. And it's not like you have the same metrics.
Yeah. Yeah. I think, some of the stuff that Trump's done, some of the executive orders, digital token orders are seemingly to allow small businesses to sort of spin up an entity not going through the full SEC registration process to get on the NASDAQ and skipping 3 years and millions of dollars of fees to be able to just sort of take an equity offering to the market. And I think there's value in that. I think there's certainly value in that. I mean, certainly peel away as much of those regulations as we can. The fact that it takes 3 years to go public is ridiculous. And so maybe there's some good from that. What would you say your overall stance is as someone who's been in Bitcoin for a long time and sort of Bitcoin has succeeded in spite of the government sort of working against it all this time? Mm-hmm. We've gone from, night and day, the Biden administration sort of massive headwinds against it, and now seemingly 180-degree difference of now tailwinds. I mean, what do you think that means for Bitcoin?
To your point about being in a long time, like, 10 plus, I don't view it as good or bad. Perhaps I'm jaded and biased towards the bad being good, right? So that I'll readily admit that. But I think for businesses around that ecosystem, it is very good, right? So if we're talking in terms of Bitcoin's probably one of humanity's greatest inventions ever, certainly one of the greatest assets, save, maybe water, right? But as far as it being anything other than a unclenching of creative and innovative spirit, entrepreneurship, I don't think Bitcoin as an asset's affected at all.
Yeah. Well, like I said, it's done what it's done in spite of the political headwinds. Right. And so, Operation Choke Point 1.0 and 2.0 and, Elizabeth Warren's anti-crypto army and all of those types of things.
Well, and then you're the head of the central bank in Europe. So, Bitcoin has no intrinsic value. Cool. Neither does the euro.
Yeah. Yeah, which I don't believe in intrinsic value. All value is subjective.
A subjective term, right? All value is subjective, right? And if anything, I would argue that the proof of work has a kilowatt hour input to it that would serve as one of the factors that intrinsic would cover, in my opinion.
Well, at least it has a true cost of capital. So at least there's that can't be printed out of thin air.
That's controlled by free market forces, not the Federal Reserve or ECB or whatever.
Let's move on a little bit and think about sort of where we're at in this, in the bigger sense, in the macroeconomic sense. Mm-hmm. I mean, we have Bitcoin that just as of a couple of days ago broke out to a brand new all-time high, seems to maybe be retesting the breakout, maybe for support. At the same time, gold just continues to scream like a bat out of hell at this point. JP Morgan, of all people, came out with a report last week calling it the debasement trade, which of course we've known for a decade. where, we have the Federal Reserve that has now just started lowering rates. It looks like QT is about to end. Like, where do you see us in this cycle and the overall macroeconomic picture right now?
Good question. Where would you like me to start? We run.
What's your frame that you're operating in?
So a frame, and this is, I think we share in common, frame from a time horizon, duration, and like portfolio construction is infinity. You have to have an infinity time horizon and a low time preference to structure things properly. But let's zoom in and call it from '08 to now, which has been debasement. Like even the rupee made a new low. I think Argentinian bonds were breaking above 60 yield before coming on just now. The reality of the central banking era is in its end game. So whether that's 2 years or 10, I can't speak to. So that's the supra macro. Then we actually run internal a pretty epic regression model on multi-factor analysis of all countries. The problem that we have with this sort of all things M2 correlated ripping is that you historically, when you've had increases in money supply, that's been parallel with the velocity of money, which the higher the velocity of money, the more a unit of currency is turning and making everyone money, building wealth. Here we have this giant jaws where velocity of money continues to go down almost at the same degree that M2 continues to go up. So that's a concern from a spread the wealth kind of standpoint and a sustainability standpoint. That being said, we're just talking math, Mark. There is a scarcity of securities and assets. And when one side of the equation is relatively fixed, increasing at 1% to 2% a year, and the other side's just going vertical, all of those assets have to go up. And that's why correlations, gold, equities, bonds, Bitcoin year to date are around 0.9, that's the highest correlation before. And then historically, and this, when gold goes vertical in its intermediate rally structure, it slows down. Then that's when Bitcoin goes vertical, 4 to 6 weeks later.
Yeah. The Bitcoin gold catch-up trade, as they're calling it right now. So keeping that sort of gold Bitcoin ratio intact. And since gold's been on that crazy tear, as soon as it takes a little bit of a breather, just like you would if you sprinted for 400 meters, you take a big breather, then Bitcoin can catch up with that. Yeah, I mean, I guess that's pretty much the way that I see it as well. I think the whole world, as I said, we've kind of been operating this under this for a decade, but now the whole world, I think, is starting to realize, one, the governments will always print. Two, bondholders are going to be liquidated.
One way or the other.
Three,
fast flow,
yeah. Three, if I don't get out of some fiat-denominated assets, I'm going to be the one being liquidated. Four, gold and Bitcoin seem to be the lifeboat I should be jumping into, and I think the whole world is sort of catching up to that. Real quickly, what about the volatility? Now, one thing that when you sort of reference some history points, when you look at sort of, and maybe go back to, not that we're in this level, but when you look at the hyperinflation of Weimar Republic, and you can look at the German mark to gold spread, and like over a 9-year period, it's like this hockey stick that went straight up. Not unlike the dollar gold chart if you look at it right now over the last couple months. But when you overlay that chart, I'm sure you've probably seen it before. You can overlay it with the volatility, and it's just like going up and down, going up and down, and that a lot of people would say that's sort of the characteristics of this sort of dying currency, that you get a lot of that volatility, which seems to be accurate. However, I mean, right now, Bitcoin volatility seems to be like an all-time record low.
Yeah, it is, plus or minus a few points. And, when we started doing it, the vol was 190, right? And then now it's high 30s, which is about 30% above equities.
What does that mean for everybody listening, 190 or 30?
So 190, it means 190 is the realized volatility number. And essentially, it's just telling you what could be the percentage deltas within the given period you're analyzing. Typically implied volatility numbers, which is different than realized, you have to put either a 14-day, 30-day, 6-day, 9-day. Those are the common vintages of those numbers. The ones I'm quoting you now is 30-day volatility.
Okay, so is that sort of the percentage it could move up or down in that 30-day window?
Correct. And that On the realized side is based off the actual price action. Implied side is based off put and call option pricing.
Okay. So 190. So the moves up and down were much more exaggerated. Now they're down to 30. So it's very muted.
Yeah, I think right now it's at 38 to 36 plus or minus.
Yeah.
I don't have the option grid in front of me.
Why do you think that is?
Well, you've got, I think 53%, give or take, of Bitcoin holders are 5-year plus. Another 11, 12 are 2-year plus. You just don't have that many folks who are willing to sell. Then you look at on exchange, available on exchange, it's at an all-time low. So there's just not the level of supply, in my opinion, to give at least huge downside thrusts. And then you look at the nature of ETF investors. They tend to have even longer time horizons, much longer time horizons than digital asset traders, and maybe will meet Bitcoin. So they're only, call it year-to-date type of, maybe even 2-year type of vol-inducing events are really associated with short volatility products that trade on equity and or ETFs for Bitcoin, and then the leveraged perpetual futures. Those events are what is causing some intraday volatility here, but you really are not having full-scale VWAP style liquidations at size, which is not giving you a giant drawdown in a 12-hour period.
And how does that compare to gold, NASDAQ, NVIDIA, etc.?
From a volatility perspective or
Yeah.
mechanical?
No, from a volatility.
Yeah, so it's roughly, so if that vol is measured by the VIX, right? And then bonds are measured by move. And so I think VIX is around 16. So you're looking at twice the volatility S&P, probably 30% more than the NASDAQ. The move has been high on bonds. I don't know the number off the top of my head, so I don't want to misspeak, but I know it's trended higher than VIX. So call it, maybe that's 20.
Okay.
And so that's just, but you could also extrapolate, forgive me being a mathematical purist, if that VIX is 20, how many hours is it allowed to trade to manufacture that 20? If we extrapolate 9:30 to 4 to 24 hours, does that vol number become more in line with Bitcoin?
Right.
And I would argue, yes, it's going to get close. So the prism with which people are analyzing is distorted by the short duration, in my opinion.
It looks like ever since the ETFs came online, the volatility just dropped. And so I'm curious, is that because of, with the ETF, then all the traders came in, the institutional traders, the creation of all these additional products, the options products, and that sort of keeps it collared in now because everyone's sort of like running like long, short strategies at the same time? Governments will never stop printing money, so inflation, it's not going away. Now, if your money's not earning at least 10% a year, you're losing purchasing power. Now, that's why I talk about Bitcoin. It's the number one way to beat inflation and secure your future. And the question I get asked almost every day is, where do you buy your Bitcoin? Now, for years, I've personally used River.com, and I only take on sponsors that I use and I trust. And I trust them because River's Bitcoin only, they have 100% reserve, and they keep your Bitcoin safe in cold storage with no middlemen. And you can actually talk to a real person, a US-based support dedicated manager. Now, try getting that peace of mind from Coinbase. Of course you can't. Now, the perks, if you set up auto buys, you can pay 0 fees. Plus, instead of your bank paying you, 0.4% on cash, River pays you 3.75% on cash paid in Bitcoin. So if you're ready to build your Bitcoin position with confidence, go to river.com/markmoss and get up to $100 in Bitcoin when you sign up. Because freedom starts when you own your money, and your money starts with Bitcoin.
Yep. So right now, as of this morning, you had on the CME futures, which is paper, not Bitcoin, right? And the IBIT, there was a 9.8% net annualized spread, right? And so if you've got this buy side on the ETF that's going to buy it for the sole purpose of getting that arbitrage that's fairly delta neutral and lower cost, it's not going to create that downside volatility from heavy selling. So that's one side of it. But then, well, Chris, none of the 30 indicators show we're even breaking out to overbought, yet we've been going up for a few years. Where are we in the cycle? Well, you then have to understand the upside cap that occurs, right? Whether it's an MSTY, right? And mark my words, these are pieces of shit vehicles, right? Because
Okay.
what they're doing is creating what's called short gamma positioning and creating yield out of selling upside, right? They sell calls to give you the so-called yield, and that creates a price wall. Because what does a dealer have to do if he or she's giving you premium and buying the call from you? To hedge their book, they've got a short. So you've got this kind of, call it vol ribbon or band, that is limiting huge downside, but also limiting big breakouts. And those dynamics are mechanical.
Right. And so as it gets bigger, more institutional investors come in, we get more types of trading and options products on top of it. We could very well, maybe should expect that range to be held within that range and potentially even tighten.
Until you get a break, right? So somebody's going to get lopsided. This is like, look at AMD or Oracle or Intel. Like, how do these large caps gap up 30%? Well, somebody's out of position, right?
Okay.
Either via short calls, short future, short the stock, whatever it is to get them out of position. And then you can kind of have a reset occur.
Yeah.
But I would argue,
Go ahead.
no, I would just argue that there's going to be, until further notice, contained upside and downside volatility.
Yeah. I was going to say Bitcoin used to have these really explosive moves, and then it would catch all the shorts off sides and then squeeze them, and then you get an even bigger move. But those days don't seem to be happening so much anymore. And to your point, right, they just continue to get collared in tighter.
Mm-hmm.
So yeah, it's interesting. From a trading perspective, if I had a loan, if I borrowed against my Bitcoin,
Mm-hmm.
let's say I borrowed 50% of my LTV to buy more Bitcoin. So I've levered up, but I want to hedge my loan so that I don't get a margin call. What type of option would I buy that if it dropped, it would give me enough income to cover that margin?
So that's difficult because, as you know, there's 5 major Greeks that go into option pricing, right? So what would be the term of the loan? If you gave me the margin level at 50.
Yeah. So let's just call it 10% for 12 months.
Yeah. So you're going to match the duration of the loan. So
I'd want a 1 year. I'd want a 1 year call.
Right. Put is what
or
you
put.
say.
Yeah, put.
Yeah.
Sorry.
And you'd probably go no more than 20% more out of the money, because with a 50% LTV, you don't have to protect all 50. Right. So, and you can just assume on.
I'd want to prepare for a 60. I have to assume what I think the drawdown would be. So let's say I'm at 50% LTV, but I think maybe the worst we'd see would be a 70% downturn. So I only have to really protect that 20%.
That's exactly why I got that number, by the way. Yeah. So you read my mind. And essentially, you got to write off the put premium that you're paying, because you'll have many instances where the theta is decaying. So the price is going to decline over time because you're paying for that when you're buying the option. And then in order to monetize it, you have to wait for the event that's occurring real time, so that option blows out to the upside and hedges your downside. The problem as time goes on, as the ferocity of that hedge decays.
Okay.
So depending on the other Greeks, you may look like, okay, I'm buying a 12-month option to hedge 6 months. Then I'm going to exit and rebuy another 12-month option to hedge the remaining 6 months. That way you're streamlining the decay rate.
Right. And then if it never drops and I never actually, then I guess that would expire worthless and I lost the money. And
Correct.
that's the price I paid for the insurance.
That hedging doesn't make money. It costs money.
Right. Exactly. But I'm just trying to protect myself. I don't have more margin to collateralize the loan with. And so for a small fee, a point or 2 points on the loan, for example, then I could buy that insurance for myself.
Yeah. And then writing, it's capital efficient, as you know, Mark. You're writing off the interest cost on the loan as well.
Right.
And then the capital you're receiving to make the purchase is not taxed at income.
Yeah. Yeah, I think it's just important. I mean, right now, it's the hodler's dilemma. I never want to sell my Bitcoin. I've made all this profit, but I don't want to sell it. I guess I can borrow against it, but what if I get a margin call? What if the market drops by 80%? There's all the what ifs. And so then that's where options came in for all the what if scenarios, right? So you can cover those what ifs for a small fee. I believe that's how, well, I guess it was futures, right? Originally came out for farmers. It's like, how do I hedge or was it for cattle?
Yeah. It was John O'Brien was his name, from RJ O'Brien. Yeah.
Yeah. And he's like, I don't know how many cows I'm going to have or if they'll die. So I'll just sell you a contract on it, now. And then the trader takes the other side of the bet. Right.
Mm-hmm.
Let's just talk quickly about price levels. So, I don't typically think about this. It's the question I get asked most often. Where will Bitcoin's price be by the end of the year, by the end of the cycle or whatever? And, I try to think years out. But, as you're more of a trader, I'm just curious what you think. It looks like Bitcoin is following a pretty classic chart right now. And it just broke out, right? Hit a new all-time high 25. It's pulled back. It looks like it's trying to potentially set up this new price level as support. And then, I don't know, 135 and then 150 are sort of those next price targets, or like, what do you see when you look at that?
It's a little sad, right? Like, I want to see ferocity, right? I want to see panic on both directions, right? And so how it's manifesting its expression to me is one of containment, to be honest. Down or up. I'm unbiased because, like you mentioned, I'm not monetizing any of my BTC. This is legacy planning. You can always borrow against it. I only want more, but I don't want to buy a breakout, right? I want to buy a correction. So I think people need to look at the cycles we've seen and redefine them. So in the truest trader sense or market analytic sense, from when it came out to now, is actually one secular cycle. And
the whole 15-year history.
Yeah. We've had cyclical market cycles within that many are calling the 4-year cycle. You can't put a date on it, on cycles, right? It's because all cycles are a manifestation of only two things, and it's psychology and liquidity, and they ebb and flow. So looking here, I can't, I'll give bear and bull and base case. So I'll start with base case. The breakout's good, but we need to see follow through, right? So it could, if we knife through the 109 low, then this is kind of a bull trap, and we're going to continue in a correction that I think is, you could term since July, where it's been just chopping sideways, right? So if it just has a little whip, $1,000 above the previous 124 high, then that would be a classic kind of bull trap. And it's still going to stay in this kind of correction that I would argue would be limited to maybe 97K on the downside, if that at all, right? To the upside, the next pivots from here are more in the 137, 140 range. And then actually 150 is just kind of psychological. The next one's at 180 range. And what I like to advise people to look at is a confluence of things. And what I mean by that is using trend lines, when I say the word pivot, I mean support and resistance levels, and then just applying a Fibonacci grid to it. And you can see in quantitative terms where all three or more of these things line up. And that gives you a higher probability of understanding the picture.
Yeah, it looks like we just kind of keep having these step ups and then consolidation, right? So it looks like from 2024, like February to November, for the whole year, we sort of just ranged in that, 60,000, 40 to 60,000 range, right? Then it shot up, was that November 24, and it's kind of been in this like 80 to 100 range. And now it's in the 100 to 120 range.
Yeah. And that's why it's kind of boring, right? Because I mean,
to go from 60 to 120 is not so boring, but yeah, from what we've expected from Bitcoin in the past, I guess it could be.
Right. And then I'm also inputting my own little frustration with the correlation to equities, because equities have infinity risks more than Bitcoin.
Sure.
Right. And why should they have any correlation? And most of its life, it's not had any it's been 0.49, I think, at the highest. So I think that's maybe on the bear case. That's kind of my biggest.
Could it be because you mentioned psychology and liquidity, and could it be because the liquidity is more in the driver's seat and all these assets are benefiting from the rising tide lifting all boats?
100%.
Yeah.
And then the reason gold's going up, and then I do think this is subjective, right? I think Bitcoin's another catch up to gold. There's this counterparty risk management.
Right.
And I talk to, we run two hedge funds. I talk to institutions and huge family offices. They're buying at any price. I can tell you, being a professional asset manager in the space 8 years, everybody's like, well, I kind of want to buy under 100, Chris. There's so much money waiting to buy Bitcoin. It is insane. Now, either it's going to run away from them, right? Or it keeps ratcheting up, as like you're saying, oh, well, shit, I missed 100. Now it's 180 to 130. And then, okay, then 8 months later, whatever it is, then it's 225 to 180. And it's just going to keep doing that, maybe in that pattern.
Yeah. Yeah.
And so I always like outlining a trading plan that can resolve and solve for anything.
So as somebody who's been in Bitcoin for a decade, it's about the time I've been in as well.
Mm-hmm.
What a run it's been. But you also have two hedge funds that are centered around trading around Bitcoin, I believe.
Yeah.
So correct me on that. And then the question I wanted to ask is, how do you look at, like, here's my savings, my long-term Bitcoin, and then here's what I'm trading with or trying to create alpha with?
Right. That's why we ended up designing. So I had already been running, went out of college to Morgan Stanley, 2010 spun out and started a volatility arbitrage fund. In that business, came across Bitcoin, did personal investment, then actually invested in one of the first Bitcoin ATMs on their raise. This was, I think, maybe Q2 2015, somewhere around there.
Like an actual ATM machine that you can get cash out over.
Yeah.
Okay.
And it was a friend from the commodity space he left that to go start this up. He was out of Chicago. Okay, sure. And then just going back to Hayek and Rothbard, it was just, wait a minute. This isn't just cypherpunk money or magic internet money. This is, and gradually as I further got it, it's like, well, my partners and I were like, we're just going to accumulate this like we were already doing gold because we were already gold bugs. How do we use our skill set to dump more AUM in just for profit and have that kind of feed into the accumulation? And we ended up designing the multi-strategy fund that basically always holds, call it 25 or 30% in cold, that then gets rebalanced with gains from algorithms, and et cetera. So it's kind of like there's a portfolio of quantitative strategies that feed into the accumulation within the fund.
Okay.
And then, I'm not going to pay the government to tax on the gain I have on the Bitcoin. I'm just not going to do it.
On your Bitcoin.
Yeah.
Obviously the fund buying and selling, that's a different story.
Right. But then it can wash itself between losses and be tax efficient from harvesting. And then, when you lose, if you have a down year, it's a write-off against income. So you don't really lose.
Yeah, when you're doing it through a business entity. So you have two different funds and they're running two different strategies?
Yeah, one is a trend following fund, and we partner with CoinDesk on it. It's the first hedge fund that trades the CoinDesk 20 large cap basket. And we kind of designed it for institutions that needed a diversified exposure. Bitcoin's 60% of it anyways. And that's a little easier to understand because it doesn't have the complexity of SATOG, market neutral, momentum, HFT, where we have 13 algos in the main fund or the multi-strat. So yeah, one is more of a, what I would call DeFi and Bitcoin maxi kind of fund. And the other is, okay, replace your equity allocation with this. This is vol controlled, risk controlled, and diversified exposure to digital assets. I have my own money in both, obviously, or that would be malpractice, but there's just bells and whistles on one, simplistic elegance on the other.
Yeah. Yeah. Okay.
And it happened organically. We only intended to have the one fund, but there's some good people in the space. And I think not Bitcoin's one benchmark, and then there needs to be another benchmark, right? Because let's say I was a precious metals fund. I'm not going to only trade gold. Like, how could I how could I do that? That's kind of silly.
Yeah. Okay. All right, Chris. Well, I think we went around the world in Bitcoin pretty good. I think that sums it up. I mean, it's just so much happening with politics and the macro and the charts, and it's hard to keep up for most. But, you know, I asked you kind of at the beginning sort of like what your operating framework is. You know, for me, it's simple. Governments will always print money.
Yeah.
As long as they continue to debase money, I'm going to continue to buy hard assets.
And even if they weren't, you would continue to buy hard assets, which is why that's the answer anyways. Right. Because legacy planning, which we are both doing now at our age range, that's agnostic of your fiat price you're entering in now.
Right.
And I think that the risk that they have austerity and stop is almost zero. And we have to be cognizant of the, call it 10 to 12% risk. All of a sudden the lights go out because they went Weimar cubed. Like relative to Weimar, in terms of the quantity of currency that came in post Versailles Treaty, we are orders of magnitude higher than that. And then what is it? Gold, USD is down 45% year to date as of today. So
on the Dixie.
Yeah. Like, I mean, holy Christ almighty. So I'm with you 1,000,000%, but we just have to understand the debt unraveling is out there. But ultimately what occurs at that point, there's liquidity one event, and then the hardest assets rise the fastest and the furthest after that event occurs.
Yeah. Yeah. I mean, the Dixie's come down quite a bit, but you could argue that historically it's more in the 80 to 90 range. And so we might still have quite a bit to come down, but I absolutely agree with you on that. And the thing with the, you know, back to the hyperinflation of Weimar Republic, I mean, the bar set to be considered hyperinflation is so high, 50% month over month over month. Like, okay, so if it's only 40% month over month, that's not hyperinflation, right? I think that it's like pretty crazy, either like no inflation or hyperinflation. And so everything's like a spectrum in between there. But I think, you know, yeah, I think we just kind of, that's my framework I operate from. Obviously, you know, Bitcoin makes the most sense, scarce assets, scarce properties, gold, etc.
I tell people, I said this to politicians when we were up there, Bitcoin's the embodiment of the Bill of Rights in technological form. No, there's nothing, even gold has way more risk than Bitcoin. They're just different. People think risk means price. That's not what risk is. Risk is on the human's execution of the trading and investment plan and the holding and maintaining the position in that asset, right? Fiat only goes one way. So price outside of a 60-day prison doesn't even matter.
Right. Yeah. All right, Chris, we're gonna hang it up with that. I want to make sure we'll link down to your funds in the show notes down below. If anybody wants to reach out to you, they can get a hold of you. Anything else you want to draw attention to before we wrap it up?
No, I think people just, you know, stick to a well thought out trading plan and deploy assets wisely. And Bitcoin's the fastest racehorse I've ever seen. So
yeah, cool, Chris. Well, thanks for joining me today. It's fun.
Yeah, thank you. Thanks for having me.